Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden within company filings. Today we're diving deep into C2 Blockchain, Incorporated's latest report. Let's see if this company is building a digital empire or just playing with virtual blocks. Before we jump in, if you love getting these insider looks at corporate filings without all the fluff, make sure you hit that subscribe button. And for real-time discussions and more insights, join our Discord community. The link is in the description below. This report is like a quarterly checkup for the company, telling us how things went in the last 3 months ending the 31st of December 2025. It is a snapshot, and sometimes that snapshot reveals a lot more than just numbers. First off, let's get a sense of the company's overall picture. C2 Blockchain Incorporated is trying to make its mark in the digital asset space. They're involved in things like cryptocurrency mining and managing digital money. Think of it as a digital bank and a tech company rolled into one, but still very much in its early stages. One interesting point right off the bat is that they haven't been posting all their digital files online as much as they could have. This might seem small, but it can sometimes point to how organized a company is with its digital footprint. They've got quite a few shares out there, which is standard for many companies. We'll need to keep an eye on how these numbers play out in terms of ownership and value. Now, let's get to the heart of the matter, the money. The financial statements are where we find out if the company is making progress or heading in the wrong direction. Looking at their balance sheet, it's a mix of things. On the asset side, they have cash and equivalents, which is basically money they have on hand or can easily get. It is a small amount, just $1,177 at the end of December 2025, up from $9 in June. That's a huge jump in percentage terms, but still very, very low in absolute dollars. A big chunk of their assets, $597,465, is in cryptocurrency. This is a key part of their business, but it also means their value can swing wildly with the crypto market. They also have a company vehicle worth $58,570, which is a tangible asset, unlike the crypto. Overall, their total assets are $659,713, which is a significant increase from $75,551 in June. This growth is largely driven by their cryptocurrency holdings and the vehicle. On the liabilities side, they owe money for things like accrued liabilities and a loan for that new company vehicle. But what really stands out are the convertible loans and a derivative liability, totaling over $1 million in current liabilities. That derivative liability is $852,645. This is a complex financial instrument that can represent a potential future obligation or value. It is a big number and something we'll need to understand the implications of. And then there is the stockholders' equity, or in this case, a deficit. This means that if you were to subtract all their liabilities from their assets, they'd be in the negative. A deficit of $440,915 at the end of December 2025 compared to a deficit of $8,449 in June. This is a critical indicator. A negative equity position means the company owes more than it owns, which is a serious concern for its financial health. Let's switch gears and look at how they performed over time. The statement of operations. This shows their income and expenses. For the 3 months ending the 31st of December 2025, they had zero revenue, and for the same period in 2024, also zero. It's not until we look at the 6 months ending the 31st of December 2025 that we see a tiny bit of revenue, just $44 from staking rewards. For the 6 months in 2024, again, zero revenue. This highlights just how early stage they are and how they are not yet generating significant income. But look at their expenses. For the 3 months ending the 31st of December 2025, operating expenses were $162,691. That is a massive jump from just $4,780 in the same period in 2024. For the 6 months, it's $465,624 compared to $12,564. This huge increase in expenses without a corresponding rise in revenue is a red flag. The result, a net loss. For the 3 months ending the 31st of December 2025, the loss was $87,485. A year prior, the loss was much smaller, $4,780. For the 6 months, the loss ballooned to $2,457,466 from just $12,564 in the previous year. This widening gap between expenses and revenue is concerning. This statement details how the equity, or in this case, the deficit, changed. Starting with a deficit of $8,449 in June 2025, we see a series of transactions. They sold common shares, bringing in $1,675,000 and $275,000 in later transactions. They also issued shares for a loan guarantee and financing costs. But even with all these share sales, The accumulated deficit kept growing, reaching $2,755,250 by the 31st of December 2025. This means the losses are outpacing the money raised from selling their stock. This brings us to that large negative equity of $440,915. The company is burning through cash fast, and while they issued a lot of stock, the losses are still making their overall equity position worse. Now let's look at where the cash is actually going with the statement of cash flows. For the 6 months ending the 31st of December 2025, they used $453,201 in cash from their day-to-day operations. This is a huge increase from $12,564 used in the same period in 2024. This means their core business operations are draining cash at an alarming rate. Investing activities also used a lot of cash, $1,721,634. This was mainly for buying more cryptocurrency and that company vehicle. Contrast this with zero cash used in investing activities in 2024. They are actively spending money to acquire assets, which is fine if those assets are expected to generate returns. But with their current revenue situation, it is a risky move. On the other hand, they brought in $2,176,003 from financing activities in the 6 months ending the 31st of December 2025. This mainly comes from selling more stock and those convertible loans we saw earlier. It is how they are keeping the lights on, but it is essentially borrowing money or selling ownership pieces to fund operations. Despite all the money flowing in from financing, the net change in cash is only $1,168. This means that the money coming in is just about covering the money going out, and they are left with a very small increase in their cash balance, ending up with that $1,177 we saw on the balance sheet. The company itself, C2 Blockchain Incorporated, formed in Nevada in 2021. It is a development stage company, meaning they are still building their business and haven't achieved full operational capacity. They are focusing on crypto mining and digital asset management. A key point here is how they value their cryptocurrency. They record it at fair market value, meaning its value can change daily based on market prices. Any gains or losses from these changes are reported in their operating income. This is where a lot of that volatility in their financial results comes from. This is a crucial note. The auditors are raising a big question mark about whether the company can continue operating for the next year. They point to negative trends like operating losses, a shortage of working capital, and bad financial ratios. They haven't made much revenue, and they rely on selling stock and related party contributions to stay afloat. This is a serious warning sign. They have a net operating loss carry forward of $2,755,250. This is essentially the amount of money they've lost over the years that could potentially be used to reduce future taxes. However, because they haven't been profitable, they can't be sure they'll ever use this benefit. They have a dispute with a vendor over $12,500. It is not a huge amount, but it shows there can be disagreements even in small business dealings. This note gives more detail on their crypto holdings. They bought $1,661,044 worth of crypto during this period. They also mentioned selling Cardano tokens at a loss of about $12,666. The table shows their crypto value went from $62,474 in June to $597,465 in December. That is a massive increase, largely due to market appreciation, but also due to new purchases. This is where things get really complex. They have convertible notes that can be turned into stock. One note with Coventry Enterprises LLC has a $20,000 discount and legal fees, resulting in only $170,000 in proceeds instead of $200,000. They also issued shares as a guarantee for this loan. Another note with Quick Capital LLC has similar complexities, including a variable conversion price, which triggers derivative accounting. The fair value of these derivative liabilities, which are tied to these convertible notes and warrants, is significant. As of the 31st of December 2025, the derivative liability related to conversion options was $574,890, and for warrants it was $277,754. These are complex financial instruments that can create uncertainty. The note shows the derivative liability, which was zero in June, jumped to $852,644 by the end of December. This reflects the increasing value of these complex financial instruments as the company's stock price potentially fluctuates, or as the terms of the agreements evolve. Here we see more details on their stock. They authorized a lot of common stock, 500 million shares, and have issued over 410 million. A significant portion of shares were sold in private placements and a regulation ACI offering. For instance, they sold shares for $100,000 through a Reg AI offering and $1,850,000 through private placements. They also issued shares as commitment stock for loans. This section is management's view on what is going on. They highlight that their business is heavily influenced by the volatile digital asset market. Their cryptocurrency holdings are a big part of their assets, and their value can change dramatically. They even tried to develop an AI chatbot for crypto, but paused it. This suggests they are exploring different avenues, but might be struggling to focus or find success in any one area. As we saw in the financials, revenues are minimal, essentially zero for the most recent quarter. They acknowledge that staking rewards are very small. They explain the big jump in operating expenses by pointing to increased general and administrative costs, including consulting fees and financing activities. This means they are spending more money on running the company and trying to raise capital. Management attributes the increased net loss to higher operating expenses, interest, and those derivative-related adjustments. They're facing costs that are growing much faster than any income they're generating. This is about their cash situation. They only have $1,177 in cash. Their current liabilities, the money they owe in the short term, are over $1 million, mostly due to those convertible notes and derivative liabilities. This is a classic sign of a company struggling with liquidity. They again emphasize the huge risk tied to their cryptocurrency holdings. The value of these assets can plummet, and any bad news in the crypto market could severely impact their ability to operate. Reiterating the auditor's warning, management admits they have recurring losses and insignificant revenue, which casts serious doubt on their ability to continue operating. They are hoping to get more funding through equity and convertible instruments. As a smaller reporting company, they are not required to provide detailed information on market risk. This means we don't get the deep dive into how interest rates or currency fluctuations might affect them, which is common for smaller businesses. This section deals with internal controls. They admit their disclosure controls and procedures are not effective. The key issues here are that authority is concentrated in one person, Levi Jacobson, who seems to be the CEO, CFO, and director all rolled into one. There is a lack of independent directors and an audit committee, which means there is not enough oversight and duties aren't properly separated, which increases the risk of errors or even fraud. These are significant weaknesses in how the company is run. This part covers other significant events or disclosures. They mention the dispute with the vendor over $12,500 again. No lawsuits have been filed yet, but it is a pending issue. Because they are a smaller reporting company, they don't have to go into detail on risk factors in this report. However, we've already touched on the major ones, like crypto volatility and their weak financial position. This details their stock sales. They sold a lot of stock in private placements to raise money, over $1.8 million in private placements, and another $275,000 from other stock sales, plus that $100,000 from the Reg A CO offering. They also issued shares as commitment stock for loans. The money raised is going towards general business purposes and working capital. This is just a list of official documents they filed with the SEC. Finally, the report is signed off by Levi Jacobson. He is wearing many hats: Chief Executive Officer and Chief Financial Officer. The date of signature is the 20th of February 2026. This reinforces the idea of a company with very concentrated leadership. So what is the story here? C2 Blockchain Incorporated is a classic example of a development stage company trying to make it big in a very exciting but incredibly volatile industry. They are generating almost no revenue, losing money rapidly, and heavily reliant on selling stock and other financing to stay afloat. Their cryptocurrency holdings are a significant asset, but also a major source of risk. The fact that they have a deficit in stockholders' equity and that auditors are questioning their ability to continue as a going concern are serious red flags. The concentration of power in one individual, Levi Jacobson, without independent oversight, is another big concern. While he's clearly working hard, that lack of checks and balances increases the company's risk profile. The company is essentially betting on the future growth of cryptocurrencies and hoping to secure enough funding to reach profitability. The big question is whether they can survive long enough to get there. Their massive increase in intangible assets related to cryptocurrency shows they are doubling down on this strategy, hoping for a big payoff. But the path to profitability is extremely steep and the financial risks are substantial. What is your take on C2 Blockchain's future? Are they poised for a crypto comeback? Or is this a ship sailing into choppy waters with very little cash in the hold? Let me know your thoughts in the comments below. If you found this deep dive valuable, please give this video a thumbs up and subscribe for more corporate reality checks. And don't forget to join our Discord community for more discussions linked in the description. Thanks for watching Corporate Decoder, and we'll see you in the next one.